Okay, let's take this gradually. Let's look at the first example, paddle and skip. And let's see what they're talking about here. Like I say, we are literally bringing this together as though you own the whole business. So as though you had, Paddle here is the parent. Paddle acquires 75% of Skip several years ago. No problem. Thank you very much. So what's their situation for this year? Well, individually, this one has no adjustments. So Paddle did 2.4 million. Skip did 800. I'm adding those two together. And those are the costs. I'm adding them together. Like I say, dividend received from Skip, this will not show up at all. So we right, let's carry on. Lecture part 2, chapter 19, part 2, paddle and skip. Let's look at a pretty straight example here. Paddle and skip. Paddle controls, paddle bought Skip, 75% ownership technically, so you control the whole thing. We're literally just merging these two things together, literally adding, where is that? Here we are, adding those together as we go along. That's what we're really doing. So, yeah, that's it. There's no funny adjustments here, no intertrade, no intergroup trading, so that's fine. We can ignore that. Here you've received some money from Skip, so this has to be, if you like, eliminated. We can't show income from ourselves. It just can't work, so we completely leave this out, if you like. I mean, sometimes it's interesting to know the double entry. I mean, really, Paddle would have said debit bank credit, if you like, credit dividend received. I'm just imagining that really Skip would have said that, of course, their credit bank and debit retained earnings, because, of course, you pay your dividends out of retained earnings, if you like. So really, because when I say you leave it out, in practice, this would be journaled out. We don't need to know that. All we need to know is that you would technically now debit this dividend and credit retained earnings of the individual company, of the individual subsidiary, which is Skip. So when I say credit retained earnings, if you like, in the statement of changes in equity over there. But our interest really is, the key point here is this has to come out. So this has to come out. So we ignore that. So Paddle cannot show any of this sort of income. It must all be only third party related income. Yes? And then, of course, this is income tax. There's no income tax. We know this income tax is purely on profit. There is no income tax on divvies recognized in here. And there we are. Let's look at the answers here. So you can see what they've done here: 2,400 plus 800. You've got that. 2,160 plus there. You have that. Then you have your income tax expenses. You can see the divvies have disappeared. Profit for the year. Now, again, like I said, I might have mentioned earlier on, I'm going to have to come back here and sort of say, listen, what bit of this does the subsidiary own? In effect, I highlighted earlier on that this is in effect working too, isn't it? You had some retained earnings at the beginning, you had some retained earnings at the end for that year, and then you have 40. So the subsidiary gets 25% of this, doesn't it? Because that was the profit made in the year. You can see that's why we have here 25% of that profit, which is 10. So take 10 off this, and the rest, of course, must belong to the parent. That's to the parent. Cool, great stuff. And that's that. That's the first example. This is your most and your nicest straight-off version. So I talked about provision for unrealized profit, POP, when we did statement of financial position. But just talking about it again, what we have here, I'm going to talk about it conceptually, and then, of course, sort of do the double entry. So imagine your parent, or whoever it is, has bought some inventory. They've got some inventory, and let me just give myself a clean screen again. Just sometimes it's good to see it over and over again. What you want to do is you want to watch out for the presentation and then work it from there. And once you do that, you'll find they've bought some inventory. It's 10,000. So they have gone debit purchases, if you like, credit some trade payable. This is the original purchase. Parent bought this. Now parent sells it to the subsidiary for 15,000. So parent now recognizes this revenue of 15,000. right? If you like, in some intercompany current account, debit trade receivables 15,000. 15,000, right? And by virtue of doing this, immediately they recognize a profit of, because they no longer have the inventory, you see, closing inventory is zero. So they recognize, because in their accounts, they no longer have the inventory is all gone. So they are recognizing, if you like, a profit of 5,000. That's what our problem here is. Our problem here is we suddenly have, so you've literally moved inventory from one room into another room. You now control the whole thing, and you've called it 15,000. Just by moving it from one room into another. This is what happens with group accounting. So in effect, you had A is equal to C plus L, of course, plus E. So you have, stock is an asset. You can say debit expense, credit liability, or debit asset of stock. It's up to you, 10,000, and you owe someone 10,000. And what you've suddenly done is you just move it to another room and then add 5 on it, call it 15,000 and recognize profits of 5,000. That's not right. So that I just changed my pen color to emphasize what I therefore now have to do. I need to bring that down by 5 and bring that down by 5 because you cannot make profit by simply moving inventory from one room to the next. Now, of course, if I've sold, imagine I'd sold half of this and therefore half of this had left the room. So in effect, half of the profit is now realized, but there's half of stock still left. So there's £5,000 worth of 5,000 real valuation of stock being currently recognized at, of course, half of this, which is 7,500. So the point, therefore, is that we now have an unrealized profit of not 5,000, of course, but of 2,500. So your question or your task is always just to find what stock is left and what markup has been put on that stock, or what's the difference between the original cost and what it was sold for, whatever, using your methods, any method that you're working with. Right, and therefore, I guess the whole idea simply therefore must be that if you remember that opening inventory plus purchases minus closing inventory is equal to cost of sales. So I'm just going to show you, sure you know what's going on here. Imagine I have 1,000 here as my opening inventory and I buy £3,000 worth of stock and my closing inventory is, say, I don't know, let's just say my closing inventory is 500. So cost of sales is 1,000 plus 3,000 minus 500. So that's 3,500. Of course it is, isn't it? 4,000 minus 500. Now, here's the thing. If I reduce the value of my closing inventory, say for example, I'm like, oh, listen, this isn't good. This is, for whatever reason, if I reduce the value of my closing inventory, so I'm just going to reduce that to 100, right? So if I reduce my closing inventory and value of my closing inventory, what you notice, of course, right, is that my cost of sales must go up because it's going to be 1,000 plus 3,000. That's 4,000. 4,000 minus 1,000, that becomes 3,900. So anything that affects my closing inventory indirectly affects my cost of sales. There's an inverse movement. So whenever we drop the closing inventory by crediting it, we are in effect increasing the value of the cost of sales. That's why we tend to add on. If you look at the presentation, you see them adding on this perp to cost of sales, because in effect you're reducing closing inventory, but in effect adding on increasing cost of sales. So I mean, this is really what you're seeing, if you like. This is the real issue here. This is the real original movement here. By us, if you like, doing this via cost of sales, by adjusting closing inventory via cost of sales, and therefore crediting it in the statement of financial position. This is the journal, the real journal of what's really happening. But in the consolidated statement of financial position, we don't see that. So the only way to do that is to sort of credit closing inventory and debit retained earnings to kind of do this, to make this happen, right? That's what we do with perps, right? Remember? So for perps, we credit the closing inventory, definitely, and we debit the retained earnings of whoever's got the profit. But we can see it clearly in the consolidated statements of profit or loss. We can effect that change via the actual retained earnings, which is the profit or loss account, by doing it via cost of sales. And this closing inventory, of course, is in the statement of financial position. Okay, great stuff. So let's look at this question here. So it's an illustration. On the 1st of Jan, Zebedee acquires 60%, so he controls the thing. this has happened. All of this. This is great. So I'm technically, again, just bang, adding all of these guys up, if you like. Investment income from Xavier. I know I cannot show this, but that's not going to happen. So it says during the year end, Zebedee sold. So it's always just watching. They could show this. They could present this in any way. You just have to be alert and dynamic and versatile with understanding what's going on. So it says during the year, Zebedee. I'm just going to use a number of ways to explain this. Zebedee sold. So Zebedee sold 84,000 worth goods. It says these goods had cost Zebedee 56,000. So Zebedee had got these goods for 56,000 and sold them to this other party for 84,000. So basically making a profit of 20. Where's my calculator? Can't believe I can't do that with that just by looking at it. 28, yes, of 28,000. I mean, again, you could have done this in a range of ways. You just have to make sure you're happy with knowing, right, this is technically the markup on this 56, right? So if that's the cost, if I'm looking at markup, well, that's 28 over 56, right? So the markup is 50% in markup language. You could look at it like that. I mean, it's up to you. The whole thing here is 84,000. Just make sure you're comfortable with it. Brilliant. So now that I know what the markup is, I can always work out what the perp is, what the situation is for anything. So it says here that Xavier still had 36,000 worth of these goods in inventories, well held at cost to Xavier. So this is pretty much the selling price, right? So Xavier had bought these goods from, this is this is the value of the goods marked up, 36,000. So if it's marked up, Xavier is holding goods worth 36,000 that have been marked up, and if they're marked up, that means they're held at markup, which is at 150%, but they need to be held at 100%. Because that's the original. I mean, you could play with it here, couldn't you, and see what's going on, but it doesn't matter. I'll go straight to the markup discussion. So therefore, if I need to know what that 100% is, what the real cost should be, well, I need to literally just divide this 36,000 by 1.5. And dividing 36,000 by 1.5, I believe, should give me 24,000. Yes, let me just check my calculator, sorry. Just to be 100% sure. 36,000. Oops, sorry. 36,000 divided by 1.5. Yeah, that's 24,000. Which means that the perp, or the unrealized profit, is 12 grand. And that needs to come out. And so that needs to come out of closing inventory, but technically I need to add it on to cost of sales. So let's go here. So what do we see here? Oh, sorry, forgive me. We actually had, so that transaction of 84,000 happened. So that needs to come out, right? So if you like I said, that was the actual intercompany transaction. That transaction cannot be allowed, if you like, to hold. That transaction needs to be removed. So we remove it. So debit revenue and credit purchases, getting rid of it. But we still have closing inventory with which is too high. So if you like, I need to get rid of that closing inventory by adding that on as well. And literally, that's it. Those are the main issues really, and the rest is just really adding everything else together. There you are, adding the distribution costs, adding the admin costs, adding your income tax, and then with regards to understanding what's happening with this subsidiary, that's 134. You had 60. That means this non-controlling interest had 40%. So 40% of 134 is what belongs to the non-controlling interest. The non-controlling interest weren't the ones who sold the goods, so there's no pup. There's no pup. Look at that here. That's the 40% times the 134, which is equal to 53.6. Yeah, cool, great stuff. Yeah, I think that's kind of the way to look at this. And then you can see that once you get that 53, once you take that 53.6 out of this one, you will have the 478.4 left. Awesome, great stuff. So that's we'll move on to to transfer of non-current assets, and then I think we'll see where we'll talk a little about that, and then do the next TY, the next TYU. See you in the next video.